Hi, I'm David, and you're watching The Global Finance. We cover fresh financial headlines, hidden stories from financial history, and simple insights to help you understand what's really happening behind the numbers. I'm not a financial professional, and nothing here is investment advice. Let's get started. February 17th, 2026, Washington, D.C. Commerce Secretary Howard Lutnick sat down with a document that had been months in the making. 3 projects, 3 locations. 3 numbers that, taken together, told a story not just about trade policy, but about something far larger, about how the rules of global capitalism may have just shifted permanently. The first number was $33 billion. That was for Portsmouth, Ohio, a natural gas power plant that would become the largest in American history. 9.2 gigawatts of capacity, enough to power every home in the state of Ohio. Enough electricity to run the equivalent of 9 nuclear reactors, built and operated by SB Energy, a subsidiary of SoftBank, the Japanese technology conglomerate controlled by billionaire Masayoshi's son. The second number was $2.1 billion. That was for the Texas Gulf Coast. A deepwater crude oil export terminal, the GulfLink terminal, operated by Sentinel Midstream that, when fully operational, was projected to generate up to $30 billion a year in American crude exports into global markets. The third number was $600 million. That was for Georgia, a synthetic diamond factory operated by Element 6, a subsidiary of De Beers, the world's largest diamond producer. Not jewelry diamonds, industrial diamonds, the kind used to polish semiconductor chips to tolerances measured in nanometers. The kind used in precision military manufacturing, the kind that right now the United States gets almost entirely from China. Add those 3 numbers together, $36 billion, first tranche of $550 billion. The largest single-country foreign investment commitment in recorded history. That memo crossed Lutnick's desk, went to the White House, and within 24 hours, Donald Trump posted on Truth Social what may become one of the most consequential sentences of his presidency. He wrote, "The scale of these projects are so large and could not be done without one very special word, tariffs." That one sentence is what this video is about. Because what Trump just did, whether you love him or hate him, is something no president in American history has ever done before in quite this form. He turned tariffs into a financial weapon, not just to block imports, but to redirect hundreds of billions of dollars of foreign capital into the United States. And the playbook he used is older than you think. Before we go deep into this, hit that subscribe button and drop a comment below telling me, do you think this investment deal actually benefits Japan? Or is this economic coercion dressed up as partnership? I read every single comment. And now let us get into it. This video is verified by Bloomberg, Reuters, the Japan Times, the Business Standard, the White House official fact sheet, and on-record statements from Commerce Secretary Howard Lutnick and Japanese Trade Minister Ryosei Akazawa. The numbers I give you are not speculation. They are confirmed, documented, and cross-referenced across Tier 1 news sources. All key sources are linked in the video description. By the end of this video, you will understand exactly how tariffs became a new instrument for redirecting global capital flows, something that almost no one is naming correctly. You will see why this pattern appeared before, in a different form, with a different tool, and what happened to the countries on the receiving end. You will recognize which countries are likely next in this sequence, and you will understand what this structural shift means for energy prices, supply chains, and your own financial positioning. Let me start with a question nobody is asking. Why is Japan doing this? I do not mean the surface answer, lower tariffs, trade deal, obvious political calculus. I mean the structural answer. Why is the world's 3rd largest economy allowing a foreign government to handpick where it invests its money in exchange for a tariff rate? That is not how sovereign nations normally operate. That is not how capital allocation normally works. Unless the alternative is worse. And to understand that, we need to go back 40 years, September 22nd, 1985. The Plaza Hotel, New York City. Finance ministers from 5 of the world's largest economies, the United States, Japan, West Germany, France, and the United Kingdom, sat down to sign what would become known as the Plaza Accord. The official explanation was that they were correcting an overvalued dollar that was hurting American exports. The practical consequence was something very different. At that point, the Japanese yen traded at 240 per dollar. The United States had a massive and growing trade deficit with Japan. American manufacturers, from automobile plants in Detroit to electronics companies in Silicon Valley, were being undercut by cheaper Japanese exports. Congress was furious. A group of Republican members literally smashed a Toshiba radio on the lawn of the Capitol building in protest. The political pressure for something dramatic was overwhelming. The Plaza Accord delivered that something. Japan was pressured to allow the yen to appreciate. The stated goal was 10 to 15%. What actually happened was a 50% appreciation. By 1988, the yen had doubled in value from 240 to 120 per dollar in 3 years. Japan's export-driven economy, which had been the engine of the post-war economic miracle, suddenly found its products 50% more expensive in international markets. Exporters were hemorrhaging. Growth was decelerating sharply. Tokyo's response was to flood the domestic economy with cheap money. The Bank of Japan slashed interest rates from 5% all the way down to 2.5%. Stimulus poured in, and all that liquidity had to go somewhere. It went into real estate. It went into stocks. Between 1985 and 1989, Japanese stock prices and land prices tripled to quadrupled. The Nikkei index climbed toward 40,000. By the late 1980s, prime land in central Tokyo was the most expensive on Earth by square meter. At bubble peak, the Imperial Palace grounds were even notionally valued above all California real estate. And Japanese investors flush with cheap yen and stratospheric asset prices went shopping in America. They bought over $100 billion of American real estate in 4 years. Rockefeller Center in Manhattan, Pebble Beach Golf Course in California, office towers in Los Angeles, hotels in Hawaii, not because they wanted to own American landmarks for sentimental reasons, but because the Plaza Accord pressure forced Japanese capital out of Japan and into dollar-denominated assets. American strategic real estate got acquired with Japanese money under conditions that Japan did not fully choose. Sound familiar? A dominant economic power faces a trade imbalance with Japan. It applies economic pressure through a formal mechanism. Japan, unable to resist unilaterally, acquiesces. Capital starts flowing into the United States. American strategic assets get built or acquired with Japanese money. Check. Verified. Undeniable. Now here is where intellectual honesty requires me to stop and give you the full picture. Because this channel does not traffic in simple narratives. The Plaza Accord was driven by currency pressure, a blunt, destabilizing tool that contributed to a bubble that, when it burst, destroyed 3 decades of Japanese economic momentum. The Nikkei did not return to its 1989 peak until 2024. The Japanese real estate market has still not recovered. The probability that the 2025 tariff deal produces the same catastrophic outcome for Japan is, in my honest assessment, lower. This deal is structured around low-risk infrastructure returns, not speculative asset purchases. The 50-50 profit share, the loan guarantee structure, the enforceable investment timeline, these are more sophisticated instruments than the raw currency shock of the Plaza Accord. The bull case is that Japan earns stable long-term returns. The bear case is that it has committed sovereign financial capacity to an agreement it could not really refuse. But the underlying dynamic is identical. A dominant power using economic leverage to redirect allied capital into itself. That part has not changed. Let me show you historical example number 2, because Japan has been here before. From a completely different angle, 1948. The United States had just emerged from the Second World War as the only major economy left standing. Europe was in ruins. Japan had been firebombed and then atomically bombed into surrender. And Secretary of State George Marshall stood at a podium at Harvard University and announced a plan to help rebuild Europe, a framework for economic recovery that would later be known as the Marshall Plan. The Marshall Plan provided $13.3 billion, equivalent to approximately $137 billion in today's purchasing power, to 16 Western European nations over 4 years. The conventional history is that America gave this money out of generosity and Cold War strategy. Both of those things are true, but here is what the textbooks rarely emphasize. The Marshall Plan required recipient nations to use the aid money to buy American goods. American steel, American machinery, American grain, American manufactured products. America was not simply rebuilding Europe out of pure altruism. America was routing European reconstruction spending through American factories, creating captive markets, securing long-term trading relationships, and embedding itself into the physical infrastructure of allied economies for a generation. Check. Verified. Undeniable. Now flip that picture to 2026. Japan invested $33 billion to build the largest gas power plant in American history. Japan invested $2.1 billion to build an American crude export terminal. Japan invested $600 million to build an American factory that will supply 100% of U.S. demand for synthetic industrial diamonds, eliminating a critical supply chain dependency on China. Japan is providing the capital. America is receiving the strategic assets. The geopolitical leverage in the form of supply chain independence, energy infrastructure for artificial intelligence, domestic critical mineral manufacturing flows entirely to the United States. The financial return flows partly back to Japan. The formula is the Marshall Plan, but inverted. The world's largest economy is now the strategic infrastructure beneficiary, not the benefactor. Same pattern. Different direction, different century. Now you might be thinking, but did not the Marshall Plan ultimately work out well for everyone involved? Yes, and that is precisely the point. The genius of these mechanisms is that they work well for everyone while structurally advantaging the architect. Western Europe recovered. American factories boomed. The Cold War containment of communism succeeded. Everyone got something. But the United States got the most: captive markets, political influence, and the positioning of the dollar as the anchor of the new global monetary order. That asymmetry was not accidental, it was designed. If you are still watching, smash that like button. It genuinely helps the algorithm surface this kind of analysis to people who need to see it. And comment below, who do you think benefits more from this deal, America or Japan? Let me show you the third historical anchor, and then connect all three to what is happening this week. 1944, Bretton Woods, New Hampshire. 44 allied nations gathered to design the post-war international monetary order. The result, the dollar became the world's reserve currency. Every nation needed dollars to buy oil, to settle trade, to maintain foreign exchange reserves. This gave the United States what economists call exorbitant privilege, the ability to run persistent trade deficits because the entire world had to finance those deficits by holding dollar assets. It was, structurally, the greatest sustained financial advantage in the history of nation-states, but that advantage was not maintained by magic. It was maintained by a web of bilateral arrangements, the petrodollar system with Saudi Arabia and the Gulf states, security guarantees to Japan and Germany, technology transfers to Korea, market access agreements across Asia that kept dollar demand alive and kept America's allies both dependent and aligned. The arrangement was mutually beneficial most of the time, but it was also asymmetric. America got the seigniorage, the right to print the world's currency, to effectively tax every trade transaction on the planet. Everyone else got stability and market access. The tariff for investment deals of 2025 and 26 are a variation on this architecture. Instead of running deficits and issuing dollars, America is threatening tariffs and accepting capital flows. Instead of petrodollar recycling, where oil revenues get invested back into U.S. Treasury bonds, it is tariff investment recycling, where trade surplus recycling gets directed into American physical infrastructure. The structural logic is identical. America's market access is the premium product that no major export economy can afford to lose. Allies pay for access. The form of payment has changed. The underlying relationship of dependency has not. Sound familiar? Because we are in the middle of this pattern right now. Not might will. This pattern continues. Now here is something I need you to understand about the $550 billion figure. Because you have probably seen the headline and assumed it means $550 billion of actual cash moving from Tokyo to Washington. That is not what is happening. And this is the part that almost every news outlet buries in the 15th paragraph. Trade Minister Akazawa was explicit. Only 1 to 2% of that $550 billion would consist of direct cash investments. 1 to 2%. The remaining 98 to 99% is structured as loans and loan guarantees, underwritten by two Japanese government agencies, the Japan Bank for International Cooperation and Nippon Export and Investment Insurance. Now you might be thinking, does that make this deal less meaningful, less of a real commitment? Here is why the answer is still no. Government loan guarantees are real financial obligations that expose Japanese sovereign balance sheets to genuine risk. When Japan's state agencies guarantee a loan on a $33 billion power plant, and that plant fails to generate sufficient returns, Japanese taxpayers are exposed. That is not a hypothetical risk. That is a contractual obligation backed by national balance sheets. They mobilize private Japanese banking capital. The three major megabanks are already in co-lending discussions. And the enforcement mechanism is airtight. Once a project is selected, Japan has exactly 45 business days to fund it. If Japan declines, it forfeits distributions and risks tariff reimposition at 25%. The leverage is structural, ongoing, and enforceable. Before you say this is just some paper commitment with no teeth, consider the pace. Japan moved quickly to implement the September Memorandum of Understanding. The first joint consultation panel convened on December 23rd. The first project announcements came February 17th, just over 50 calendar days from that inaugural panel meeting. For a sovereign investment program of this scale, that is extraordinarily fast. That pace tells you the enforcement pressure behind it is real. The mechanism is more elegant than a wire transfer. But the strategic outcome is identical. American infrastructure gets built with allied capital, under American directional authority, serving American strategic priorities. And if any ally balks, look at what is happening to South Korea right now. Trump threatened 25% tariffs in late January for slow implementation. Seoul's parliament is working through the weekend to pass enabling legislation. The mechanism has teeth. Let me bring this to you personally. I am not a financial advisor, but here is what the data suggests about what this structural shift means for your financial exposure. First, American energy and artificial intelligence infrastructure. The 9.2 gigawatt Ohio power plant is not a random infrastructure project. AI data centers require extraordinary amounts of electricity. A single large language model training run can consume as much electricity as several thousand American homes do in a year. The United States is currently facing an energy capacity crisis. Grid infrastructure cannot keep up with data center demand. The waiting lists for new power connections in some regions of the country are measured in years. Investors who tracked energy infrastructure build-out during previous technology waves, the internet era, the mobile era, consistently saw outperformance in utilities, industrial real estate, and grid equipment suppliers as demand scaled. This deal accelerates that build-out by years, not months. The question worth asking is, which sectors benefit from $33 billion of power plant construction in Ohio? Second, synthetic diamonds and the semiconductor supply chain. China imposed export controls on synthetic diamonds in 2025. The United States relies on China for most of its industrial diamond grit, the material used in the precision cutting tools that make chip manufacturing possible, the heat sinks that keep advanced processors from melting, and components in radar and weapon systems. A domestic production facility covering 100% of American demand is a structural reduction of a specific geopolitical risk. That kind of supply chain insurance historically reprices sharply when geopolitical escalation accelerates. We saw that with rare earth elements. We saw that with solar panels. Industrial diamonds are next. Third, the South Korea signal. South Korea has a parallel deal. $350 billion of investment commitments in exchange for 15% tariffs. As of this week, Seoul is lagging. Trump threatened 25% tariffs in late January. South Korea's parliament is rushing to pass enabling legislation before month end. Germany and Australia have not yet reached deals. The template is live and documented. It is reasonable to anticipate that it will be applied again to other major trading partners who run persistent trade surpluses with the United States. Germany runs one of the largest trade surpluses in the world. Australia supplies critical minerals that America wants to onshore. Both countries will face this conversation. Fourth, what the data from analogous historical periods shows investors who held exposure to host country infrastructure and manufacturing assets during forced capital repatriation episodes. From the Plaza Accord era to post-war reconstruction, consistently saw those sectors outperform broader markets during the initial investment phase. Whether that pattern holds this time depends on execution and regulatory durability, but the directional signal is worth tracking carefully. This is not about whether this deal is fair. It is not about whether Trump's tariffs are constitutional. A U.S. appeals court has already ruled most of them illegal, and a Supreme Court decision is pending that could reshape everything. It is not about whether Japan chose this freely or whether coercion is too strong a word. Reasonable people can disagree on all of those questions. This is about understanding the mechanism as it actually operates in the world. When the mechanism is working, and right now, the evidence suggests it is working, dismissing it because it offends your political sensibilities is a luxury that markets will not extend to you. Let me be direct about what we know and what we do not know. We know the deal is announced. We know the first 3 projects are selected. We know Japan has 45 business days to fund each one. What we do not know is how the profit-sharing structure will function in practice over a 30-year power plant lifetime. We do not know whether future American administrations will honor the terms. We do not know whether the Japanese banking sector's co-lending will materialize at the scale required. And we do not know whether the tariff enforcement mechanism will survive legal challenge. Those are real uncertainties. Analysts and investors will watch for early execution signals in the next 6 months. The bull case for this structure is an American industrial renaissance, energy abundance, allied supply chain resilience, critical mineral independence, and a rebalancing of global trade relationships that reduces long-term systemic risk. The bear case is a fragmentation of global capital flows into bilateral political arrangements that are less efficient, more politically fragile, and more prone to distortion than the multilateral rules-based order they are replacing. Probably elements of both futures materialize simultaneously. History rarely gives you a clean outcome. What I can tell you with confidence is this. The financial instrument that launched this week in Ohio, Texas, and Georgia will be studied in economics textbooks 20 years from now. Not because $36 billion is historically unprecedented, but because it demonstrated for the first time in the modern era that a major power can use the credible threat of tariffs to redirect the sovereign capital of a close ally into domestic strategic infrastructure legally, voluntarily in the technical sense, and with a profit-sharing structure that makes it look like a business deal rather than a tribute payment. That distinction between coercion and investment, between tribute and return, is exactly where the next century of geopolitical finance will be contested. Not on battlefields, not in courtrooms, in investment committees, in tariff schedules. In the boardrooms of sovereign wealth funds, making decisions about what to build, where to build it, and whose permission they need to proceed. Subscribe now if you want to follow this story in real time as it develops. South Korea is still working through its $350 billion commitment. Germany has not signed yet. Australia has not signed yet. What happens next will not be decided by headlines. It will be decided by project approvals, funding deadlines, and enforcement step by step, tranche by tranche. If you want the next update the moment it breaks, subscribe. Thanks for watching.